Hi everybody, Thomas Moore here. With the start of a new calendar year, it's a great time to think about the approach you intend to take to building your retirement savings. Individual retirement accounts, or IRAs, are a tool that's available to all working Americans and provide a flexible way to build retirement savings on your own terms. A lot of people have heard of IRAs, but they don't really know very much about them or how they work. The IRS provides a lot of information about the different types of IRA accounts, and yet they remain a mystery. In this video, I want to talk about the two most important types of IRA accounts, regular IRAs and Roth IRAs. There are some differences between the two types that I think make them both useful depending on your circumstances and needs. I'll also talk about why smart investors don't just use 401k contributions to build their retirement savings, but make sure to include IRA accounts as well. Most Americans have access to some kind of employer-sponsored qualified retirement plan in the form of a 401k or some similar variation. The problem is that most people don't think about retirement savings beyond the scope of those employer-provided plans. 401ks are a terrific tool, and if you have access to one, you should absolutely be making monthly contributions. Let's talk about some of the differences between them and IRA accounts. First, the IRS treats the contributions made to the different types of retirement accounts in different ways. 401k contributions are made on a pre-tax basis, meaning that they're applied to your 401k account before taxes are calculated on your employment income. That lowers your taxable income, thus lowering the amount of taxes you pay each month. Regular IRA contributions, on the other hand, are made after tax, which is why the IRS may allow you to deduct the contributions made to a regular IRA account. Roth IRA contributions are also made after tax, but are not deductible. I'll talk about the reason for this difference in a few minutes. The investment choices available to 401k accounts are dictated by your employer, which usually selects from a range of choices offered by 401k plan providers. Most often, your choices will include a variety of mutual funds. Moving your investments from one mutual fund to another is possible in 401ks, but is limited to the funds provided in your plan, and the logistics are often deliberately confusing. Investments in regular and Roth IRA accounts, on the other hand, are limited only by IRS regulation, but they allow for practically any type of market-based investment vehicle you prefer. Mutual funds, CDs, bonds, stocks, and a variety of non-margin options trading strategies are all allowed. Other possibilities include precious metals and real estate. I prefer to focus on market-driven vehicles, including stocks, options, and bonds. That means that you can direct your investments in an IRA account in any fashion that you prefer. You can manage your IRA account as actively or as passively as you feel best fits your needs and objectives. Another important difference between 401k accounts and IRAs is found in the amount of allowable contributions for each type. You can contribute up to $23,000 per year into a 401k, while IRAs are limited to $7,000 per year. The higher amount allowed by 401ks is the primary reason I think anybody with access to a 401k should take advantage of them. But that doesn't mean you shouldn't also make IRA contributions. The two together create diversification of the tax treatment of your eventual withdrawals, to say nothing of the additional compounding you can realize by making contributions to both account types. The last element applies to catch-up contributions. Catch-up contributions are another reason I believe there is a significant advantage in IRA accounts that 401ks don't provide. Catch-up contributions are additional contributions on top of the typical maximums that the IRS allows for individuals over the age of 50. While 401ks have a higher catch-up amount, those contributions would be subject to the same investment limitations as your regular 401k contributions. When you take the same $7,000 and put it in a regular IRA or a Roth IRA, however, you can add an additional $1,000 per year after age 50. Contributing to a 401k prior to age 50 along with IRA contributions up to $7,000, gives you the net effect of making those $7,000 per year 401k catch-up contributions before they're actually available in the 401k. The $1,000 additional catch-up IRA contributions after age 50 only expand the compounding opportunity in the IRA account even more. Roth IRAs may not be available to you if your income is above a certain level. However, these limits are well above the average income of the majority of Americans, which means that the odds are very good that you can contribute the full allowable limit of $7,000 each year. Regular IRAs have no such income limit. If you have earned income, you can make the full contribution each year. Depending on your income level, the contributions you make into a regular IRA account may be tax deductible. At tax filing time, that deduction may work in your favor to lower your yearly taxable income and therefore your total tax bill for the year. In some cases, it may even translate to a tax refund. With a Roth IRA, contributions are not tax deductible in any form, which may make them less attractive if you rely on tax deductions at the end of the year to receive a tax refund. One of the most important differences between Roth and regular IRAs comes into play when you begin to take distributions. For all qualified retirement accounts in the United States, the minimum age to begin withdrawing money is 59.5 years. If you're withdrawing from a regular IRA, those withdrawals are treated as current taxable income. That's a characteristic regular IRAs share with 401k withdrawals because both accounts are provided with tax advantages at the contribution stage. Since Roth IRA contributions have no tax deductibility, withdrawals can be made tax-free after age 59.5. This is one of the greatest arguments for Roth IRA accounts, since tax-free income means you can enjoy your hard-earned money without worrying about an annual tax bill. The final important difference is how long you can keep money in the account before taking withdrawals. In a regular IRA, you are required to start taking distributions at age 73, regardless of circumstance or need. With a Roth IRA, there is no mandatory distribution age. That means that if you don't need the money, you can leave it in the account and let it continue to grow. Since all IRA accounts can be passed on to beneficiaries, that means that Roth IRAs can provide greater inheritance sums to your loved ones than a regular IRA. So, what is the better choice, a regular IRA or Roth IRA? The answer really depends on your circumstance and preference. If you have 30 or more years to retirement age and are just getting started in your professional life, a regular IRA may provide more immediate advantages in the form of tax-deductible contributions. On the other hand, if you're a little bit further down the road of life, or have built a level of income that makes tax deductibility of contributions a moot point, then a Roth IRA is probably a better choice, especially since these accounts provide tax-free withdrawals after age 59.5. Regardless of your choice, regular IRAs and Roth IRAs share one important common characteristic. They give you complete control of how you'll put your money to work for you. I've built Rebel Income to provide useful monthly income if being able to live on your investments is a priority. It also works extremely well as a conservative, highly successful way to build wealth over time if you don't need that income to cover living expenses. All of the trades I publish in my Rebel Income service can be made in both regular and Roth IRAs. If you want to see what I do and how I do it, check out my Patreon page and consider signing up for my Rebel Income Toolbox or Trading Alerts. You'll find the link to that page in the description area for this video. You can also click here to subscribe to this channel where you'll get notified about stocks I spotlight and videos like this one. This video is a good example of the kind of content I like to publish here. Thanks for watching. This is Thomas. Talk to you again soon.